Hello everybody, it's Ben Kumar and Tom Sheridan from 7IM. We're here to talk about the Q3 2018 portfolio positioning inside the various risk profiles in 7IM. And in particular, we're going to focus on the balanced funds, or the balanced model portfolios. Now, for those of you who know 7IM, you'll know that we have a long-term asset allocation, where over the long run we know how much in equities and fixed income and alternatives and in currencies that we'll have. And we also have the ability, quarter by quarter, to shift those allocations to reflect what we think is going on in the world. Those market views of what's going on in the world are contained in our Global Markets Update. Now, Ben, at the moment, our normal equity position for a balanced portfolio is about 50%, and guess where we are right now?
At about 50%. Our tactical view and our long-term strategic view exactly aligned.
So within the individual regions, are there any marked differences between our current positioning and what our long-term views are, and if so, why?
There aren't many. The diversification offered by our long-term asset allocation is pretty good, and we don't see any drastic reason to change it. One thing that might look odd to people is the weight we have in the UK. People ask us, well, what about Brexit? Aren't you worried that's going to affect the UK equities? And the answer really is no. UK equities are doing pretty well. Their earnings are growing because the UK economy is growing. The additional factor, though, is that sterling is getting a little weaker. Now, lots of these companies in the UK have earnings from abroad, and as the pound gets weaker, those earnings go up. So we're seeing a really positive tailwind for UK equities that is perhaps getting lost for some people among the Brexit noise.
So at the moment, we have what we would describe as a very normal, broadly diversified allocation to equities on a global basis, typical of 7IM portfolios over the long haul. Fixed income, we have made a change to fixed income. We had more of an underweight position than we currently have. Tell me what we did and why we've done that, please.
So what we've been doing is moving back into global government bonds. Now these are low risk, safe haven assets that if the equity market goes through a bit of a wobble, will tend to do quite well. The reason we've been underweight for the past few years is because interest rates were so low, in emergency mode. And that's starting to change. And as it changes, global government bonds look more attractive.
So a nice safe haven asset to have in the portfolio. Now, we don't like corporates and high yields as much as we had done in the past. A word on what that logic is, please.
So corporate borrowing costs have got really, really low as interest rates fell. Now rates are rising, those companies are going to have to pay a little bit more to borrow. And we think that they might not enjoy that so much. They're going to have to spend a little bit more of their earnings paying back their debt. And it seems like that's not going to be sustainable in the long term.
And indeed, the margins, the incremental yield that you get for corporates over government bonds is at all-time lows right now. So the incremental risk for the incremental reward we don't think is really there as it was before, and hence the move that we've made. Emerging markets, we've got a sort of a normal 7 or 8% allocation to emerging markets. What's the story there?
Emerging market bonds offer really high yields. They offer good diversification as well. There are lots of countries in the emerging market index who are borrowing money, paying about 7 or 8% to do so, with diversified currencies, diversified economies. We think that's a really good option for investors over the long term to be exposed to this kind of growth, this growth in economies, and to have some diversification from the fact they're spread around the world.
Okay, and from a currency perspective?
From a currency perspective, the emerging markets have been hit a little recently by the dollar strength. Now, as the dollar gets stronger, those currencies get weaker. We believe that that's gone a bit too far. Those economies are pretty good. The currency should rebound, adding a little bit of a kicker to the return.
So long story short, we think emerging market debt represents good value at the moment. Alternatives. The reason for the alternative investments in a 7IM portfolio are to try to find positions that don't behave like equities or like fixed income through the course of a cycle. Now, we've lightened up a little bit on our alternatives and moved some of that money back into bonds. Can you give us a little flavor on that?
Sure. The main thing we've done is sell down our global inflation protection certificate. This was essentially something that we put in place a few years ago to say if inflation surprised to the upside, it would make some returns. We saw that happen this year. So we're lightening up there. We're taking our profits, moving it back into conventional inflation-linked securities, inflation-linked bonds. So all the alternatives reduction and the bonds increase mainly comes from there.
Great. So the last major variable in portfolio construction after equities and fixed income and alternatives would be the currency allocation. Now, what's our normal currency allocation and where are we at the moment and why?
So in a balanced portfolio, you'd tend to have about a third, maybe a little more, in foreign currencies. It provides diversification over the long term. You saw it going through Brexit. Sterling gets weaker, those foreign currencies do really well. And at the moment, we are at about neutral. We have about 36% in foreign currencies in the balanced portfolio for the diversification reasons we just mentioned.
So we've also got positions within there in the dollar and in the yen that, in addition to providing the diversification, act as safe haven assets. So the bonds, the government bonds that we've added, and some of the dollar and the yen positions in particular, also provide safe haven capabilities when markets get a little bit rocky. So that's where we are for quarter 3 of 2018. Ben, thank you very much. And again, thanks to all of you for your continued support. And we'll see you next quarter.